Hey everyone! Welcome to our class about understanding employment income. You ever looked at your paycheck and wondered what all those numbers mean for your taxes? Or what counts as taxable income from your job? Well, you're in the right place. In these two-part videos, we're going to break down Canadian employment income rules into easy-to-understand concepts. Let's kick things off with the guiding principle in Canadian tax law for employment income. If you get it because of your job, it's probably taxable. If you pay it because of your job, it's probably not deductible, unless the law says otherwise. Simple, right? But the unless the law says otherwise part is where things get interesting. At its core, your employment income is calculated using this formula. We're going to explore each of these components, starting with the easy stuff. First up, the basics. The Income Tax Act 5 provides general rule of what is included in employment income. Things like your salary, wages, tips, and director's fees. These are all in and all taxable. Pretty straightforward. Now let's talk about bonuses. Imagine your company declares a bonus in December, but you don't receive it until January. For employees, you're taxed on a cash basis, meaning when you actually receive the money, not when it's earned. So, that bonus declared in December 2024 but paid in January 2025 would be taxed in 2025. There's one key exception. If your employer delays paying a bonus more than 3 years after the year end in which it was declared, then it becomes taxable in the year it was declared. So, companies can't just delay bonuses indefinitely to push back your tax bill. Moving on to benefits. Employers often provide fringe benefits as additional compensation on top of your salary or wages, but not all benefits are created equal in the eyes of the tax authorities. Some are taxable, meaning they get added to your income, while others are not. The Income Tax Act 6 includes these rules. Let's look at taxable benefits. These are included in your income. Here's a list of common ones. Company-only merchandise discounts if they're given exclusively to employees. If your employer pays for financial counseling services for you, that's a taxable benefit. Frequent flyer points from a company credit card if you use them for personal travel. Cash gifts and awards are always taxable. For non-cash gifts and awards, anything over $500 per year becomes taxable. If your employer pays for life insurance premiums and you are the beneficiary, those premiums are a taxable benefit. Premiums paid by your employer for a public health care plan are also taxable. Subsidized meals that are provided to you below their actual cost. If you use employer-provided recreational facilities or club memberships for your personal benefit, those dues are taxable. Relocation allowances over $650 that are non-accountable, meaning no receipts are required, are taxable. Relocation payments that reimburse you for a loss on the sale of your personal residence when you're required to move for work. There's a specific rule here. If your employer reimburses you for a loss, 50% of any reimbursement in excess of $15,000 is taxable. For example, if you lost $50,000 on your home sale and your employer reimbursed you $32,000, the taxable benefit would be $34,000. Minus $15,000 multiplied by 50%, which equals $9,500. If your spouse travels with you on a business trip and your employer pays for their personal travel, that's a taxable benefit to you. And if your employer reimburses you for tools and you get to keep them, that reimbursement is a taxable benefit. Finally, tuition paid by your employer for a course that primarily benefits you as the employee is a taxable benefit. And just so you know, severance payments and signing bonuses are also fully taxable as employment income. Now for the good news, non-taxable benefits. These are perks that generally don't get added to your income. Health and dental plans paid by your employer. Non-cash gifts that are $500 or less per year and given for special occasions, like a birthday or holiday. Tuition for a course that primarily benefits your employer. Employer contributions to a registered pension plan, RPP, or the Canada Pension Plan, CPP. Reimbursement of actual moving expenses, provided they are supported by receipts. Although be aware, you can't deduct these moving expenses on your personal tax return. If you use employer-provided recreational facilities or club memberships, but these are primarily for the benefit of the employer, rather than your personal use. General reimbursements for employment-related expenses, as long as they are supported by receipts. Now, let's quickly cover accident and sickness insurance. The tax impact depends on who pays the premiums and whether the plan is a group or non-group plan. If your employer pays all premiums. If it's a group plan, the premiums are not taxable now, but any benefits you receive from the plan are taxable. If it's a non-group plan, the premiums are taxable now, but the benefits you receive are non-taxable. If you, the employee, pay all premiums, whether it's a group or non-group plan, your premiums are not deductible, but any benefits you receive are tax-free. If premiums are shared, if it's a group plan, the part of the premium paid by your employer is not taxable. Benefits are taxable, but you can deduct your share of the premiums. If it's a non-group plan, the part paid by your employer is taxable, but benefits received are non-taxable, and you cannot deduct any premiums you paid. Let's stick this in your mind with an example. Marcus began his employment with Demore Co. on March 1, 2024. Demore Co. provides a group disability insurance plan for its employees. Each month, Marcus is obligated to contribute $150 toward the plan premiums, an amount that his employer also matches. On May 1, 2025, while practicing for a community charity race, Marcus tripped over a stray dog and sprained his ankle. The injury kept him from work for 3 months, during which time he received benefits of $3,500 per month from the plan. He was not required to pay his share of the plan premiums while he was off work. Marcus returned to work on August 1, 2025, and resumed paying his portion of the premiums for the rest of the year. Let's see the impact on Marcus's income for 2025. Benefits received in the current year, $3,500 times 3 equals $10,500. Premiums paid up to the end of the year in which the benefit was received. For 2024, 10 months times $150 equals $1,500. For 2025, 9 months times $150 equals $1,350. The impact on Marcus's net income is $7,650. The employer contributions to the plan are not a taxable benefit to Marcus because the plan is a group plan, all employees are covered, and, in the event of sickness or an accident, the plan pays periodic benefits. Marcus is permitted to deduct plan premiums paid up to the end of the year when the accident occurred. Finally, for this video, let's talk about allowances. An allowance is money your employer gives you without requiring receipts. The general rule is that allowances are usually taxable unless they are reasonable and within the Canada Revenue Agency's limits. A common example is a kilometer allowance for using your motor vehicle for employment duties. The CRA sets limits on what it considers a reasonable per-kilometer amount. For example, in 2025, the prescribed rate for most provinces is 72 cents for the first 5,000 kilometers and 66 cents for additional kilometers. In 2024, those rates were 70 cents and 64 cents, respectively. Here's a crucial point. If your employer pays more than the CRA's prescribed rate, the whole amount of the allowance becomes taxable, not just the excess. So, if the CRA says 72 cents is reasonable and your employer pays you 80 cents, the entire 80 cents per kilometer is added to your income, not just the 8 cents difference. See this example. Maria works as a sales representative for Apex Distribution Incorporated, a company that operates across various Canadian provinces. She is required to use her personal vehicle for visiting clients. In lieu of submitting expense reports, Apex provides Maria with a kilometer allowance to cover her vehicle-related costs. During the 2025 calendar year, Maria drove a total of 6,800 kilometers for her employment duties. Apex Distribution Inc. provided her with an allowance of 75 cents per kilometer, which totaled $5,100. The impact on Maria's income for 2025 is determined by the CRA's prescribed rates for that year: 72 cents for the first 5,000 kilometers and 66 cents for any additional kilometers. The calculation of taxable allowance is going to be: total allowance received, $5,100. First 5,000 kilometers. 5,000 multiplied by 0.72 equals $3,600. Additional 1,800 kilometers. 1,800 multiplied by 0.66 equals $1,188. Total non-taxable amount: $3,600 plus $1,188 equals $4,788. Maria's taxable allowance is $5,100, the total allowance. Since the allowance provided by Apex Distribution Inc. exceeded the CRA's prescribed reasonable rate, the full amount of $5,100 is considered a taxable benefit and must be included in Maria's employment income for the 2025 tax year. Phew! That was a lot. But we've covered the fundamental rules of employment income: what counts as taxable earnings, the difference between various taxable and non-taxable benefits, and how allowances are treated. In our next video, Part 2, we'll dive deeper into more specific and often more complex areas like automobile benefits, employee loans, stock options, and crucially, what expenses you might be able to deduct from your employment income. Don't miss it. If you found this video helpful, don't forget to leave your like and subscribe to my channel for more content like this. Thanks for watching.